Week 8, Module 3, Generation Skipping Transfer Tax. I would say that of all the material we cover in this course, the hardest to comply with is going to be Generation Skipping Transfer Tax. Fortunately, at the level needed for the financial planners, it is not that complicated, but certainly for people who do taxes or give advice on the handle a Generation Skipping Transfer Tax, that is very complicated. So fortunately, for our purposes, we don't go into that type of depth. I think what we should remember is that we can do things to get around the generation skipping tax, and for example, using the annual exclusions that we used and talked about when we were transferring for family trust, estate freeze. We also can use it for purchasing insurance or annuities to be used. So let's go over the general rules that you need to know for being a CFP or really a good financial planner, not just CFPs. Imposition of the tax, it's a tax based on a transfer is made to someone 2 generations younger than the donor. That's the basic rule. And what it does is it prevents the government from losing the taxes at the death of each generation. The government is of the opinion that they have a right to a tax when a person dies, and this is the way they get it. It's in addition to the gift and estate taxes, and uses the highest estate gift tax in effect at the year of death. So again, like the estate tax, like the gift tax, we don't know what the tax rate is until the year of death. It covers gifting during lifetime and at death, just like gift tax does, but again, it's a separate tax from the estate gift tax. There's 3 situations that are used that result in taxation: a direct skip, a taxable distribution, and a taxable termination, and we'll look at all of them. Gifts and trusts that qualify for the gift tax annual exclusion may be subject to the generation skipping tax unless trust terms require, first, no distribution to any person other than the beneficiary during his or her lifetime, and at the beneficiary's death, the trust assets included in the beneficiary's gross estate for federal gross estate tax purposes. In other words, it's going to get taxed. Let's talk about the direct skip, which is the one first that's going to be subject to generation skip. It's made during lifetime of grantor, direct to a skip party, that's 2 or more generations younger than the grantor, and its transfer pays the generation skipping tax. It is tax exclusive, which means we only have tax on the value of the gift, not on the gift and the tax, and the tax is included in the gift tax return for the year. Now, in summary, what this says is if I give assets to someone 2 generations younger than me, I am subject to the gift tax, the generation skipping tax. Subject to the generation skipping tax, I have to include the tax form as an attachment to the gift tax. And actually, it is this latter part of the gift tax return itself covers it. I do not pay a tax on the tax, I just pay a tax on the value of the gift. And the nice thing about it is I know what the gift tax is right now, and I know what the generation skipping tax is. So all of it is known right now at this time. A taxable distribution is a distribution of income or corpus from a trust to a skip party. And I'll give you an example. I set up a trust for my grandchildren. They get it when they're 35 years old. The transferee, that would be the recipient, pays the generation skipping tax. It is tax inclusive, which means there's a tax not only on the value of the gift I'm making, but on the tax itself. And the rates affect the year of the distribution. So when my grandchildren turn 35, whatever that year is the rules that apply to the generation skipping tax will apply in that year. And also that's when the tax occurs. Then we have a taxable terminations. This is typically like a 2503B trust, where you would give a life estate to your children and then remainder interest go to grandchildren. Terminations caused by death, lapse, release of power and interest in property held in trust, wherein the trustee is responsible for the generation skipping tax. unlike the grantor or the recipient, this is where the trustee is responsible. It's tax inclusive, again, tax on tax, and the tax rate is in effect the year when the distribution is made. So this is, again, a situation where we don't know what the tax will be until we know the year of death. Some basic rules we have for generation skipping tax. Non-skip parties are the children of the donor and donor siblings. And the non-skip parties are not going to be taxed. The skip party is who's taxed, and that is the party who's the 2 generations below, receiving the gift bequest without prior payment of estate tax. Now, if the non-skip party pays the estate tax and then it goes to the skip party, there is no tax. It's when the non-skip party did not pay an estate tax, and that's typically when they have a life estate. Generation skipping tax is in addition to the gift and estate tax, and it's a completely different tax, different rules, although many of the rules are similar. It can be, if you make a payment of tuition and medical expense, it's excluded from taxes, just as it is under gift tax. The predeceased ancestor rule applies, which is basically if the children of the grantor are dead, then the skip party becomes the great-grandchildren, or the 3 generations down, because the logic being is that since the children are dead, there would be no gift, no estate tax paid anyhow. Therefore, the grandchildren become the non-skip party. Lifetime gifts qualifying for the gift tax annual exclusion are excluded. And you have to look at the annual exclusion for the estate tax, which is typically the same as gift tax, but I say typically, it's not always. So you have to always check it out. Items subject to tax include trust property, creation of life estates, remainders, and insurance, annuity contracts. Again, it's best to get these out of your estate, obviously, and if you have an insurance policy that you buy and give to your grandchildren, the policy itself, and you keep it under $14,000 a year or whatever the annual exclusion is that year, you're all right. It's when you set up a policy and then the proceeds go to the children or grandchildren. An unrelated person is anyone 37 and a half years younger than the donor, and it's called a skip person, and it's subject to tax. So if you are 67 and a half years old, anybody under 30 would be a skip person. So I had one situation involved that where I had a senior executive in the 60s, gave a gift to a secretary, and when he told me, he said, oh, she's about 50 years old. It turned out she was like 21, and make a long story short, a mistake was made. We did not fill out the generation skipping tax. Gifts and trust that qualify for the gift tax annual exclusion may still be subject to the generation skipping tax unless trust terms require, first, not distribution to any person other than the beneficiary during his or her lifetime, and at beneficiary's death, trust assets are included in the beneficiary's gross estate for federal estate tax purposes. We had that chart earlier, and I think it was out of place at that time. That concludes what you need to know for generation skipping tax. It is not by any means any type of real depth coverage. It is very complicated, and earlier in the course, I think it was week 4, I mentioned that although gift taxes look easy, people got out of the field of gift taxing, and it should be done only by people with expertise in the area, and one of those expertises is the generation skipping tax. Well, you now have a case study that you got to turn in. You got a quiz for this set of modules, and then you also have a final exam for the week. So I wish you best of luck.